Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Norfolk Southern Corporation, ticker symbol NSC. We're looking at Norfolk Southern today to round out our recap of publicly listed railroads. Currently, they're trading for $252.32 per share, and over their last year, their stock price is down 9%. Going back 5 years, it's a different story for the business. They're compounding at a rate of 14% annually. Over 10 years, Norfolk Southern is compounding at a rate of 15% annually. And going back prior to the global financial crisis, over the past nearly 18 years, Norfolk Southern has compounded at a rate of 11.5% annually. Their stock price is up nearly 6 times over this period. And in addition to this, they're currently paying out a 2% dividend yield. So Norfolk Southern is trading snugly between their 52-week high and their 52-week low. They're pretty much right in the middle. They are a large business. They have a $61.5 billion market cap. For more background about the company, Class 1 Railroad Norfolk Southern operates in the eastern United States. East of the Mississippi, they form a railroad duopoly with CSX, which is similar to how things play out west of the Mississippi with Union Pacific and Burlington Northern Santa Fe. On roughly 21,000 miles of track, the firm hauls shipments of coal, intermodal traffic, and a diverse mix of automobiles, agriculture, metal, chemical, and forest products. So Norfolk Southern operates in 22 states and the District of Columbia, and it was incorporated in 1980 and is based in Atlanta, Georgia. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Norfolk Southern based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public. It will continue to improve and get better over time. And so with that said, let's get right into today's analysis. Starting off with some of the key points around a potential long thesis for the business. So similar to its railroading peers, compared with trucking, shipping by rail is less expensive for long distances and is 4 times more fuel efficient per ton mile. These factors should help support longer-term incremental intermodal growth. Number 2, Norfolk Southern historically runs one of the safest railroads as measured by injuries per hour worked, and this severely boosts service levels and helps to keep costs down. Norfolk Southern reignited operating ratio improvement in 2016 after stagnating over the preceding 6 years. With help from Precision Railroading, the rail reached operating ratio records each year through 2021. Then for some of the key points for a potential short thesis of the business, coal activity will likely deteriorate over the long run due in part to cheap natural gas substitution and regulatory constraints. It's viewed that any domestic coal volume increases are temporary relief in an irreversible secular decline. Number 2, similar to other railroads, normalizing rates in the competing truckload sector and easing inventory restocking could temper intermodal's volume recovery in 2023 despite probable network service improvement. And then also similar to other railroads, chassis shortages and constrained labor availability are throttling Class 1 railroad service levels and tempering carload and intermodal volume growth. So that was trying to offer a balanced perspective of some of the qualitative aspects of the business for a potential long or a potential short thesis around Norfolk Southern. Now let's dig into their financials. First up is metric number 1, where we want their average return on capital over their last 5 years to be above 14%. So there are 2 major reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these returns are going to be captured here by return on capital. And the second is that the average publicly listed business earns about a 7% return on capital. So by asking for a benchmark of 14% here or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So Norfolk Southern earns pretty stable returns on capital in the high single digits to low double digits. Their lowest return on capital was just under 10% in 2020, and their returns have been increasing since the COVID-19 pandemic lockdowns. Over their last 12 months, they've averaged about a 13.5% return on capital. However, even though this is pretty steady and pretty stable above average returns, on average, Norfolk Southern is only earning about 11.5% returns on capital. And so again, while that is above the 7% that's typical for a business, that's below that 14% benchmark we're looking for. And so unfortunately, this is an X to start things off on metric number 1. Next up for metric number 2, here we're taking a high-level overview of the growth of the business. So we're looking for growth in their revenues, earnings, and free cash flows over the last 5 years. This metric is all or nothing in nature, and either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. We'll also be taking into account their last 12 months worth of numbers in our calculations here. So over this time, Norfolk Southern has increased their revenues by about 17%. Their net incomes look like they're down. However, that was because 2017 was an atypical year for the business. They had a one-time income tax benefit. If we were to take that out and look at a more normalized level for their net incomes are actually up over this period, so we're going to give that to them. And then additionally, and probably most importantly, is that because of some of these operating ratio efficiencies, Norfolk Southern has increased their free cash flows by nearly 73% over the last 5 years. So this is really important because free cash flow is the lifeblood of any business. And a business can use its free cash flows to reinvest back into the business, make acquisitions, buy back shares, pay down debt, or pay dividends. So ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So it's great to see such strong free cash flow growth in addition to the growth of these other two numbers, and this is a check here on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Norfolk Southern on a per share basis. So we're looking for earnings per share growth over the last 5 years. Again, we're going to be excluding their one-time income tax benefit in 2017. So their earnings are up over this period. And in addition to that, Norfolk Southern has repurchased about 17.5% of their shares outstanding. This is important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business buys back stock by decreasing the number of shares that they have outstanding, they're increasing your ownership percentage in the business, which is ultimately going to increase your percentage of the business's profits going forward. And that's being done without you having to spend a dime. So it's almost as if Norfolk Southern is making a partial acquisition of itself. So just like with any other acquisition, we want the company to be buying back shares at a price where they're getting more value than what they're paying for. This means that we want businesses buying back shares when they're trading for below their intrinsic value. You'd have to dig into these share repurchases in more detail to fully determine that. Either way, their earnings are up over the last 5 years and their shares outstanding are down. So this is very strong earnings per share growth here, and this is another check on metric number 3. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. So building off of the previous metrics, they've grown their free cash flows over this time and they bought back shares. So their free cash flows are up more than double over this time. Another strong check here on metric number 4, and so far through our first 4 metrics, we have 3 checks and only 1 X. It's a potentially great sign to see their above average returns on capital coupled with this strong per share growth, as over the long run, if they're able to keep that up, this is how a business truly compounds their intrinsic value per share. Then next up for metric number 5, here we're evaluating how the business is utilizing leverage. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and short-term investments, to be below the amount of free cash flow that they produced over the last 5 years. So Norfolk Southern ended 2021 with about $14 billion worth of net debt. Since then, they've increased this somewhat, and currently they have $14.4 billion worth of net debt. At the same time, over their last 5 years, Norfolk Southern has brought in just over $10 billion worth of free cash flow. So while their free cash flows have grown over this time frame, on a historical basis, this is not enough free cash flow to be able to support their debt load. So this is an X on metric number 5. However, this may not be as much of a concern for a business like Norfolk Southern that's a semi-regulated railroad versus what it could be like for other businesses that would have much more precarious competitive positions. Also, they've increased their free cash flows by such a large amount over this time that their free cash flows in these last couple of years have been quite a bit above where they were in 2017 and 2018. So if we were to extrapolate their current free cash flows out into the future, this would look a lot more reasonable than it did here. So those are 2 caveats that you're going to want to keep in mind. Either way, this is still going to be an X on metric number 5. And so far through our first 5 metrics, we have 3 checks and 2 X's. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium to the rate of the 10-year Treasury yield and potentially give us another reason to be interested in Norfolk Southern. So we're using their total enterprise value to give us a more accurate, more economically realistic picture of the business than their market cap would alone by taking into account both their market cap and their net debt position, which is going to give us a picture of the business that's more similar to as if Norfolk Southern were a private company. So we learned that over the last 5 years, Norfolk Southern has produced $10 billion worth of free cash flow, meaning that in an average year, they're producing about $2 billion worth of free cash flow. So when we divide their $2 billion of their average free cash flows by their $76 billion total enterprise value. That gives us an average free cash flow to enterprise value yield of 2.6%. So that is below the rate of the 10-year Treasury yield currently, and that's just slightly above half of that 5% mark we're looking for. So on an average basis, this is going to be an X here on metric number 6. Worth being aware of as well is that over their last 12 months, they're producing about $2.6 billion worth of free cash flow. So when we divide their $2.6 billion of their last 12 months of free cash flow by their $76 billion total enterprise value, that gives us a current free cash flow to enterprise value yield of about 3.4% for the business. So that, again, is just a little bit below where the rate of the 10-year Treasury yield is at, and that's also below that potential risk premium that we were looking for. So on both a current and an average basis, this is falling short of what we were looking for here for metric number 6. Keep in mind that just because this is the case does not mean that you're going to toss out this business in its entirety. This is just one metric out of 6, and this analysis is meant to be taken in holistically. Then here we're taking a look at Norfolk Southern's dividend profile. So currently Norfolk Southern is paying out a 1.9% dividend yield, which is slightly better than that of the yield from an S&P 500 ETF right now. However, people make mistakes all the time by blindly chasing dividend yield, so it's important to stop and consider whether a business's fundamentals are in good shape and whether that business can support its dividends with its free cash flows. So in all 5 of these years, Norfolk Southern has increased their dividends per share, and in all 5 of these years, they've also increased their free cash flows per share. Over this period, they maintained a comfortable margin between what they're bringing in cash flows versus what they're paying out in dividends, and this has increased even farther in recent years. So if their recent levels of cash flow are more normalized for the business going forward, then it looks like they're going to have plenty of room to be able to continue growing this dividend, at least incrementally, into the future. Again, this is a snapshot of the past 5 years worth of their performance, and this is not a guarantee, but it would appear that their dividend is in pretty good, pretty healthy shape going forward. Then finally, we're using a discounted cash flow model to come to a potential fair value for Norfolk Southern. So starting with their current free cash flows per share, and then based off of historical growth assumptions for how the business has grown their free cash flows, dating back all the way to 1990. So these are assumptions that you need to do your own homework on to determine whether or not these are going to be potentially applicable and accurate going forward over the next 20 years to give us a baseline projected estimate for Norfolk Southern. So assuming a growth stage over the next 10 years where they grow their free cash flows at a rate of about 9% annually, and then assuming a terminal stage out for the 10 years out after that, where that growth rate falls in half, if we add in their tangible book value and we're seeking a potential 10% rate of return going forward from Norfolk Southern, then it looks like a fair value for their business would be about $238 per share. So that's just $14 below their current stock price. The business hit this mark recently in October of 2022. So if you believe these assumptions and you're satisfied with that rate of return going forward, you would just want to be patient and wait for the business to get back there. Keep in mind that this discount rate would be including their dividend yield, so we would not be doubly counting their dividends. Also, a discounted cash flow model, just like any other model in any other discipline, is going to have its outputs be sensitive to its inputs. So you need to determine what's going to be accurate there. And then most importantly, this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So in summary, Norfolk Southern checks the box on 3 out of 6 of our metrics. They're earning above average returns on capital of about 11.5% annually, so that's below that benchmark we were ideally looking for. Then they've experienced modest growth with their revenues and their earnings, and they've experienced strong free cash flow growth over the last 5 years. They've also repurchased about 17.5% of their shares outstanding. Well, it looks like they're employing more debt than what their historical cash flows would be able to support. If their future cash flows are going to look more similar to their current cash flows, then it looks like the business would be able to support their debt loads more appropriately going forward. There are a couple of reasons why this might not potentially be an issue for Norfolk Southern, but if this is a potential concern, you would just want to dig into the company's filings and understand their debt profile in more detail. Then, on both a current and an average basis of their free cash flows compared to their enterprise value, that looks like they're not giving us the adequate risk premium that we'd ideally be seeking in comparison to the rate of the 10-year Treasury yield. Looking at their dividend profile, Norfolk Southern has steadily increased their dividend payouts. They've also steadily increased their cash flows over the last 5 years, and their dividend payout ratio has gone down quite a bit in recent years as their free cash flows have picked up. So it looks like their dividends are potentially healthy going forward. Then finally, performing a discounted cash flow analysis of Norfolk Southern. If you believe those historical assumptions for the business, then it looks like you could reasonably expect about a 10% rate of return going forward from a stock price of about $228 per share. So again, that's $14 below where they are currently. And Norfolk Southern did get to a low of $205 per share back in late October of 2022. So in the meantime, you would just want to be patient and do more work to learn more about the business. So it's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. Instead, this analysis serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Norfolk Southern. As a value investor, you're ultimately trying to conduct your research as if you're going to own 100% of a business, and you can truly understand the essence of that business and understand what's important and what's not important for the company going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Norfolk Southern's business, and you'll likely be able to determine for yourself what an appropriate intrinsic value for the business will be. So with that said, that's it for today's fundamental stock analysis of Norfolk Southern Corporation, ticker symbol NSC. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Norfolk Southern with me, and have a great day.